Investing is neither sophisticated or it is confusing, but there are some rules and fundamentals which you must remember when you are investing your money. Even if you have prior investing expertise, it is worthwhile to examine these. In this video we will be telling you 10 such golden rules of investing which you must know. Now let's start with the first rule. Number 1. Invest in companies you are familiar with. One thing to always remember is never to put money into stocks you don't know. Invest in your company. Additionally, investing in a firm requires understanding what it does. You cannot anticipate the performance of a stock, but you can predict how a company will perform in the future if you are familiar with the sector in which it competes and how it makes money. As a result, if you are unfamiliar with the company's operations, you should steer clear of its shares. Number 2. Avoid following the crowd and relying on tips. When you first start investing, you might be tempted to purchase and sell and buy the same stocks and bonds as other investors. The creation of bubbles in the investing market, however, is caused by herd mentality. The suggestions and counsel offered by your friends or coworkers may also harm you. The only thing your portfolio will suffer from is if you listen to such advice. Do your own study and become familiar with the market's dynamics at all times. Utilize your own research together with the most recent financial news to invest and stay current. However, do not fully rely on them. You can always come up to your financial counselor and ask for assistance. If you want to get regular tips on finances, then do subscribe our channel and also like this video. Number 3. Invest money for the long term. The stock market should be seen as a long-term investment choice rather than a way to generate rapid money in the short term. Buy low and sell high is a stock market investment strategy that we have all heard about. However, because we are unable to forecast whether the stock will increase or fall, this is not a particularly simple strategy to put into action. Even if you are able to purchase low and sell high in the short term, you will undoubtedly miss out on the potential gains simply because you sold the stock too soon. When holding stocks over a long period of time, stock market returns beat those of other asset groups. Number 4. Do not attempt to time the market. In comparison to those who succeeded in timing the market, a greater number of people have lost money. In several stock market cycles, no one has ever been able to predict the market accurately and consistently. Even the best investors cannot forecast when the market will rise and fall. Therefore it would be better if you tried to stay in the market for a longer period of time rather than attempting to time it. Once again, I would like to remind you to subscribe our channel. Number 5. Make a variety of investments. The success of entrepreneurs like Warren Buffett and Charlie Munger can be attributed to this tried and true approach. Reinvesting in equities that have done exceptionally well in previous years is a common human behavior. What was a sound wager yesterday could fail to be an intelligent choice today. Investing in just one business or industry can be dangerous due to the fact that the company or industry struggles. Your portfolio could be impacted tremendously. The most effective way to diversify a portfolio is to buy stocks with a range of market caps, including small, medium, and large. This will allow your investment portfolio to experience both growth and stability at the same time. You may reduce the risk in your portfolio and combat market volatility by diversifying it. Number 6. Never borrow money to make investments. How long you keep your stocks has a big impact on your capacity to make money in the stock market. Borrowing money to invest with is dangerous since you are required to make loan payments on time even if your investments aren't doing well. Always invest with money you have extra and won't need right away. This will provide you peace of mind because you won't have to worry about paying back your creditors even if you experience losses. Number 7. Monitor your portfolio. As a newbie, it's crucial to monitor the performance of your assets. You may rebalance and reorder your portfolio in accordance with how well it is performing. You may always review the quarterly results of the equities in your portfolio to assess their performance. Additionally, it's crucial to keep up with macroeconomic financial news and policy alterations that can affect your portfolio. You may always get in touch with your financial experts to ask for their assistance in rebalancing your portfolio. Number 8. Set reasonable goals. A lot of mental stress may be avoided by setting reasonable expectations from the beginning. It's okay to anticipate strong returns from your investments, but if you make any irrational ones, you can suddenly see your portfolio in the red. Occasionally during a bull run, equities produce gains of greater than 50% in a calendar year. The same type of returns, however, cannot constantly be anticipated. The best possible expectation is to make 15% each year from the stock market. Wishing to get more profit is just a foolish kind of thinking. Number 9. Make tiny, regular investments. It is preferable to invest little amounts on a regular basis rather than a huge quantity all at once if your objective is to create long-term wealth for you and your family. This has been shown to be less expensive and hazardous, allowing you to be more flexible with your investments. If you're a newbie investor looking to build money on the stock market, systematic investment plans or SIPs in equities mutual funds are a terrific option. Number 10. Exercise discipline and emotional restraint. Even during the longest bull runs, there have been panicky periods in the history of the stock market and the investment market. Despite the big bull runs, the untrained investors have lost money because of the market's volatility. Investors acquire stock in firms without understanding the dangers because they are unable to manage their emotions, which causes them to lose money over time. In a negative market, the same investors get worried and sell good stocks for less money. However, those investors who take a disciplined approach, invest their money methodically in the proper shares, and patiently stick to their investments to produce excellent returns. That's all for this video. Now you know all the rules of investing. Hit the subscribe button if you want to get regular updates related to finances. Do press the like button if you got to know something new from this video. Don't hesitate to comment below if you have any query. Thank you for watching.